Hello, welcome back to Weekly Market Recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw the S&P up 1.79%, which brings us down year to date only 4.68%. The NASDAQ, we saw it rise 1.98%, brings us down year to date 9.44%. So still lagging behind in the NASDAQ, but considering we were down close to 17% in the NASDAQ and over 11% in the S&P just 2 weeks ago, we've already cut both of those losses in half in the past 2 weeks. So let's look at what happened in the market. The two biggest catalysts that we had this past week were one, the Fed, and the Russian war in Ukraine factors also played into account. So really on Monday, we actually did see a sell-off, and that is due to Jerome Powell coming out and sounding a lot more hawkish, which I'll talk about in a second. But we ended up rebounding before the end of the day and then really rallying, continue staying strong on Tuesday, a little bit of a sell-off midweek into Thursday, and then end of Thursday, Friday, really just continued to rise. A little bit of sell-off beginning of Friday, and then rose to end the week almost at localized highs. So pretty strong recovery in the market. And Rich, do you want to talk about exactly what's going on with Russia and why we could have seen, especially at the end of the day, to really rise rapidly on Friday?
Absolutely. Thank you, Knight. One of the things that we're watching is as there's more fear of the Russian invasion of Ukraine becoming a much greater European war, we've seen the market drop. As it becomes more obvious that this will just be Russia and Ukraine fighting, and possibly Russia cutting back on some of its aggressive behavior and not going after taking over and regime change in Ukraine, but just settling on the eastern portion of Ukraine due to the fact that its military is not performing very well. That is a plus, and the market seems to like that. So, Dave, there's big fear about what's happening with Russia and it becoming a much more dangerous world affair where we're not quite sure what's happening. Market drop. Dave, that it becomes more clear that Russia may cut back on its demands and there may be some type of limited action, market rises. And that is what we're seeing. Now there is talk that Putin may be satisfied with just having the eastern portion of Ukraine, and the market was up a bit for that.
Yeah, so we'll move a little bit from the good news. Shocking that the good news is actually the Russian war, and get a little bit more towards some of the negative catalysts or just things that we're looking at. And right now, the biggest thing on the Fed's mind is inflation, but not even inflation as it is right now. They've already said, look, our expectation is the peak is going to be delayed another 3 months. We're probably going to see a peak more like May, June, which means we're getting that data in, June, July. We're not expecting, we need to see good numbers by September, and then we'll feel like we're on track. So current inflation, not going to be pretty. We know this. What the Fed is really worried about is not what the current inflation is, but what are the market's inflation expectation. And I'm going to show another graph. This is called the 5-year break even. And what this measures is the 5-year treasury rate and the 5-year treasury inflation protected security. And basically what that does is it takes the 5-year treasury, whatever that yield is, then you subtract whatever the yield of the inflation protected security is, that treasury yield, and you get that rate. And basically it's a way of saying this is what the market in 5 years thinks inflation is going to be. And if we look out, this is year to date on the graph, and we're obviously seeing that rise. So that says one thing, but what if we go to 3 years? Well, now we start seeing that we're actually still at one of the highest points even in the past 3 years. Okay, let's look at 5 years. We're at the highest point in 5 years. Okay, let's look at 10 years. We're currently at the highest point in 10 years. So this is where the Fed is looking and they're a little bit nervous. And so it's interesting. I said last week, I was like, you know what? I'm really looking forward to 3-4 weeks of calmness in the market. The Fed raised interest rates last week. We have smooth sailing with not a lot of drama. Well, I got surprised with over the weekend, they scheduled 5 different Fed governors to speak this week. And each one of them basically said relatively similar things of, we really need to get a clamp down on inflation expectations. We're worried about that. If we need to do 50 basis point hike, we will. And Jerome Powell got asked a question on Monday, what's stopping you from a 50 basis point hike? And he said, well, nothing's stopping us. Now, out of context, which is, of course, what everyone ran with was, oh, the Fed's going to do a 50 basis point rise. Really, he was being a little cheeky. And one, he wanted that reaction to bring inflation expectations down. But really what he was saying is the only thing that could stop us from doing a 50 basis point rise is a policy change. Like they would need to, the federal government would need to limit their power and say they couldn't do it. That's the only thing that could technically stop them. So he said, well, nothing's stopping us. We have, full ability to do so. So needless to say, that's the exact graph that we're looking at, worried about. And if that continues to rise dramatically, that's when we really start expecting the Fed to do a lot of 50 basis point rises, or maybe even higher than that, really clamping down on the market in a way that stocks are going to hate, would potentially throw us into a mini Volcker-like recession. Now, not as extreme as what they had to do back in the 80s, but it would be similar, just on a smaller scale. And one thing that the Fed has said is the biggest mistake that they made in the 80s, that regime, was they didn't get a hold of inflation expectations. Now, this is what the market...
That would have, having lived through that, getting a hold of inflation expectations would have meant that they started acting in the 70s or possibly even the late 60s. But the important part is the built-in expectation of inflation that Knight is discussing.
Now, this is the market's expected inflation rate. There's another part that's important, and it's called the consumer inflation expectations. And that release actually also came out on Friday. And the big fear is that it was 3% back in February, and everyone was wondering, okay, what's it going to be in the March release? Is it going to be a whole lot higher? The good news is it actually stayed at 3%, which is, again, above what the Fed wants at 2%. But the big fear was, is it going to jump up to 3.5%? Is it going to jump up to 4%? Because the issue with inflation is it can be a self-fulfilling prophecy. And this is important just to know. Why does the Fed care about inflation expectations? Because imagine Rich, the consumer, says, okay, I'm expecting inflation to be 5% in the future. So you know what I'm going to do? I'm going to buy more goods right now. Why am I going to wait until everything becomes a lot more expensive? I'm going to buy now. Well, what does buying now do? Buying now makes prices go higher. What does prices go higher mean? Inflation is higher. And so that's how inflation and inflation expectations, if you don't get a hold of them, is actually a self-fulfilling prophecy. And that's the biggest fear for the Fed right now. And we got some bad news on what the market's expecting on the break even. Hopefully that will start to trend down. But the good news is, again, on the consumer side, month over month, we actually saw no change. We're expecting 3%, and currently in the current month, it was also 3%. So a little bit mixed reviews on that side. And I think, as Rich was alluding to, what we saw in Ukraine has lifted the market up. But we also saw a pretty bad sell-off for the past month. So seeing a couple weeks in a row with some strong gains is not super surprising to see. And again, one of those reasons why it's so hard to time the market, because sometimes the best weeks that you have come right after the worst weeks. So as always, we appreciate you guys tuning in. We're here to support you. Your mind's here to support you, and we'll see you again next week.